Welcome to Investors Insights. Our topic today, volatility and votes. I'm excited to be here with my distinguished colleagues, Bobby Norman and Ty Miller. And I think we've got some topics for you. We might talk elections. We probably will talk about tariffs. I think we're going to talk about gas prices and also interest rates. There is a full line of topics to go over this morning, and we're excited to share it with you. So starting off, Bobby, you brought up about elections. We're getting a lot of questions from clients in regards to the upcoming elections and how that impacts the markets. Talk about that and give us your insight. I thought you did a great job in our meeting this morning.
Yeah, we continue to get more and more questions about the midterm election and the impact on the market. So I want to cover the aspects of the election today. First, as we've discussed in recent weeks, it's normal to see more volatility in the months ahead. As you can see in this chart, the volatility tends to build up as we get closer to November, with October being the most volatile month. And you can also see on the right side of the chart there that volatility actually eases after the election uncertainty is over in November. So it's completely normal for the markets to get noisy leading up to the election. But we like to point out that it's what matters after the election that matters most for investors. So as you can see in this next chart, historically, markets have performed well after the election, regardless of what the outcome is. So going back to 1950, every 12-month return after the election has been positive, posting an average gain of 16.6%, with even the weakest year still returning 3%. So as always, no guarantees, but history says investors shouldn't base all their decisions based on the election outcome, which leads us to our next chart. Is that we have been getting questions from clients a lot about how the market will perform based on which political party wins in November. And as the next chart shows, going back to 1933, that's a long time period, the S&P 500 has averaged double-digit annual returns under each configuration of party control. So average returns have been broadly similar across all three, with no configuration having a dependable edge. So this proves that over the long term, returns have been driven largely by corporate earnings, not by who controls Washington. So yes, we do analyze the election outcome, but it's really more important to focus on company earnings.
Yes, and I thought that was excellent. And folks, let me say this, we will continue having these discussions on our blogs, also our podcast, LinkedIn, Twitter, Instagram, all our social media, Facebook. We will continue all of that in the discussions as we move forward towards the elections, because we know you're interested and have concerns, and we just want to keep you updated. And Ty, you really complimented what Bobby was saying, because people at times will vote their pocketbooks, as the saying goes, their wallets. And so in elections, in addition to that, there's a lot of variables. You talked about in your presentation this morning in our portfolio strategies meeting, you discussed gas prices, you discussed possible interest rates, tariffs. So talk about that.
Yeah, I'll start with the tariffs. So you guys may recall that the Supreme Court ruled against tariffs under the International Emergency Economic Powers Act, or IEPA. And so that meant tariffs needed to be repealed, and in some cases, needed to be refunded. So what kind of happened after that was a two-step measure that's kind of taking place in the Trump administration. Step one was a temporary 10% universal tariff via Section 122, which is legal of how to do that. But the tariffs, if you go that route, are temporary and expire after 150 days. And again, are only 10% universal. So we've reached that 150-day mark. And now they are able to implement tariffs through another route called Section 301, which is a little more permanent and can be used to, hike up that rate more than 10%. So you're allowed to kind of tariff different countries in different manners. A lot of countries still get the 10% favored rate, but there are some instances where it might be 12.5%, 15%, might be reciprocal tariffs, a lot of different areas there. So wanted to make sure everyone knew that was going on. The net effect of kind of where we were with tariffs, before the Supreme Court ruled against and where we are now, there's really not a big difference there. That's important to note. But as you see in this chart here, this goes back to April of last year, of course, when we had the big tariff announcement. And you can kind of see where we started, then where we went, and kind of where we are now. So still substantially more than before April of last year, but nowhere close to that number when it was first announced. So that kind of takes care of the tariff conversation in my mind. Don't be surprised if you start seeing things in the news about tariffs coming back and things like that. It's not necessarily a huge change or something that was unexpected. And then secondly, we've been talking a lot about the consumer lately. And, one interesting thing as we have this volatility in oil prices is if you combine the mortgage rate and the gasoline prices, anytime that number gets over 10, the U.S. consumer starts to feel some pressure. And what do I mean over 10? I mean mortgage rate above 6%, average gas prices above $4. We're kind of there right now. And so as you see in this chart here, that typically does lead down to mid-cycle slowdowns or possible recessions because that does weigh on the consumer. I mean, we're talking about higher mortgage rates and higher gas prices. Those are, big expenses for consumers typically on a year-in-year basis. And so that's something that we certainly want to watch and something we want to keep an eye on. We don't want this level above 10 for very long, or you might start seeing some cracks in the U.S. consumer, which has been really resilient this far, but we want to make sure that that continues to be the case. And also the Fed's going to be watching this number. So the Fed meets this week. There's about a 60% chance that they don't do anything. The other 30-40% or so is leaning towards a rate hike instead of a rate cut. There's really no chance for a rate cut according to the CME FedWatch tool. But important to note that the next meeting after this one is in September. And right now it's telling us that there's about an 80% chance that there's going to be another rate hike, not a cut, which they've been doing, not staying stagnant, a rate hike. And so it's really going to be important as Chairman Warsh takes over and seeing what they really value, because if this stuff is temporary, which, of course, they've gotten in trouble saying that before, but that's something we certainly want to keep an eye on, because a rate hike would certainly throw a wrench into a lot of people's expectations as we came into the year.
Yeah. And so I thought both your topics and the way you tied them together was outstanding. And needless to say, we've just celebrated the 250th birthday of this great nation. And as also in 45 years being in this industry, I always say America is never dull and neither are the markets. So here we are trying to end July, and it's going to be eventful, not only in July, but the rest of the year. And with this kind of information, data, facts, we're trying to let you know what's going on, to give you knowledge and understanding, to give you confidence, so that as we move forward, you won't have anxiety and you know why we're making these moves in your portfolio or the recommendations we're making in your financial blueprint. Every day we walk into the building here at Five Plan Partners, and we always are striving to improve our clients' lives, to make them better, richer, fuller. And we thank you for taking time out of your life, out of your schedule to listen today. And hopefully it's been very beneficial. And it's not going to be dull, folks. Volatility and votes. And we're going to stick right there with you and keep you informed. Have a great week.